MANECO 64, home of alternative economics and contrarian views. This interview was conducted on Wednesday, September 9th, 2020. The views expressed in this interview do not constitute financial advice.
The mismatch from the supply and demand side, it sounds very, very appealing to me. And if I can look for one very cheap commodity, I think silver is the cheapest metal in the world today.
Today I have the pleasure of speaking with Tavi Costa. He's a partner and portfolio manager at Crescat Capital. Crescat is a global macro asset management firm. Their mission is to grow and protect wealth over the long term, and they deploy tactical investment themes based on proprietary, value-driven equity and macro models. Enjoy looking at Tavi's research. He does a lot of analysis between assets, and he uses some very interesting charts. He's also been on Real Vision. He's been on Wall Street Journal. I think he's been on RT recently with Max Kaiser. And he happens to be from where I'm originally from, which is Brazil. And it's one of the reasons why I've always been interested in inflation and the monetary system, because as Tavi knows, Brazil has had maybe about 4 or 5 different currencies in the last 60 years. So Tavi, thank you for giving us your time.
Well, thank you very much. Always a pleasure talking to another Brazilian, and congrats for all you have achieved. I'm always a pleasure to talk to someone that have had a similar experience than I did. So thanks for having me, and I look forward to this conversation.
Yeah, me too. And thanks again. I was reading your August 28th newsletter, and there's a lot that you cover there. But one of the interesting things I saw is what you call global synchronized debasement. And that interested me a lot because it's similar to the view I've had for almost 15 years. And it's the view that fiat currencies are continue to sink. They're going to, and it seems like they're accelerating now. Can we start with that?
Sure. I think that the premise of that thesis is there's really no way out of all this. We have reached a certain level of indebtedness worldwide that has been forcing a lot of central banks to debase their currency in a way that we haven't really seen before in terms of the money printing, so the monetary dilution, in order to really suppress long-term rates and rates in general, so you can continue to roll debt in general as well going forward. I think that's a recurring theme that will probably become even more prevalent in the following years. And I think we're in the race to the bottom of a lot of fiat currencies. I think more and more we're going to see an increase of alternatives, of demand for the alternatives or assets that serve as alternative to the monetary system, such as gold, silver, miners, and so forth, or they're at least linked to those ideas. And the levels of deficit that we have so far, I think something I mentioned in that letter that I think was very important to that thesis too, is since the 1970s we've had, or 1971 when we had the break of the gold standard, I think just as impactful as that was for the markets and investors overall, I believe that what's going on today, more recently with Jay Powell discussing his political, or I should say monetary views about unlimited QE, I think that has certainly been just as impactful as we saw back in 1971. And it really marked an inflection point when it comes to the monetary, fiscal, and financial lack of discipline that we've had so far. And it's certainly having an impact on currencies in general, as we see investors looking for ways of protecting against inflation, future inflation, and especially monetary debasement. I think that's a trend that will continue and will create a lot of opportunities. This is not a perma-bear view. Actually, I think there will be some really great investing opportunities worldwide to take advantage and capitalize from this thesis.
So I guess you are bullish to precious metals, but there are other opportunities out there, right?
Well, I think most of them are related to hard assets. Commodities will have, especially when you look at the commodities to equity ratio today near 50-year low. Still, I think the cyclical commodities still have a little longer to become attractive. But the lack of investments we've had, especially in the hard assets in general, for exploration of commodities, is another theme that I think will derail other opportunities, especially for companies or equities, I should say, that are linked to those markets. The lack of exploration and discoveries of commodities, just think about electrification in general worldwide. We're going to need more copper, and there's not enough discoveries of that. Silver, gold, there's not enough of that either. So iron ore, there's so many commodities that will become, or just look at the lack of investments even in the oil industry. Nowadays, oil is abundant, natural gas is abundant, but will that be the case in 5 years from now? And that's what is interesting about this, is that the hard assets in general, they kind of correct themselves through their cycles on their own. And by that I mean, when commodity prices are really high, you see, overspending in the industry in general, and that causes a lot of exploration success that we see, and discoveries, and supply gets a little excessive, and then we see a correction in prices. We're actually on the other side of things, in which commodity prices are too low, and which forces investors in general not to put money into this industry. And the lack of investments is not going to reflect anything in the next year or so. Will reflect in the next 3 years or so. So I think we're, in the next 10 years or so, I think hard assets will become more relevant in the markets. And even precious metals back in the 70s, 80s used to be an asset class in which money managers in general would certainly consider that as part of portfolio construction. Nowadays, it's all about risk parity. It's, the bond to equity type of allocation, which I think misses a lot of the opportunities in the next 10 years. And that will also have an impact on inflation that we can get into. I think the big reason why we haven't had inflation is because commodity prices have done nothing but gone flat or significantly lower in the last 10 years. I highly doubt that the next 10 years will look like that. A lot of things to unpack, but I think that's those are a lot of the opportunities that are linked to hard assets.
Yeah, and I saw in your research that you spoke about how mining companies, their finance, position is really good. Like, they don't have that much debt. You go over that, how a big an opportunity that could be, especially with the gold price at above the 2011 highs right now, and silver picking up so much.
Yeah, I think there's a lot of things also to elaborate in that thesis. The fact that those miners actually have a very clean balance sheet is certainly something we've had before during other bottoms of this industry. We went through a 10-year or so, decade or so bear market for precious metals, especially the miners, in which I think it forced them to become more efficient with and cost effective in general. And so I think the other problem was raising capital back then. I think that had an impact in terms of cleaning the balance sheets and not allowing them to raise a lot of money through debt. And so when you look at the median company in the S&P, which last time I checked, the median total debt to total assets ratio was somewhere close to 35%. It's pretty high, actually. It's the highest level in history. Mining, normal mining company is much lower than that. As a matter of fact, if the mining industry was a sector, it would be the cleanest sector in the markets today. But not only that, I mean, clean balance sheets is important because they have been so conservative recently. But I think the biggest thing that is happening in the mining space that goes back to the hard assets thesis is the CAPEX cycle. The CAPEX cycle for this industry has been, for the first time in history, diverging from metal prices. Usually when we see metal prices rising, especially at record levels, as we saw gold recently, we see miners really throwing a lot of money into their projects, and therefore CAPEX tends to rise significantly. But the lack of investments in the industry in general have forced a lot of those companies to be reluctant to spend capital, and therefore we've seen CAPEX actually not increasing, actually diverging from metal prices going higher. That just tells us that supply will remain constrained for longer, and we'll have, it's having a significant impact as well in free cash flow. Lower CAPEX and metal prices rising and companies becoming more cost effective and better at production, more conservative, and therefore free cash flow is more than double in the last quarter or so on a year-over-year basis, which I think you can't find any other industry in this market today that is growing fundamentally the same way that the precious metals industry is. And the interesting thing about the miners is that when you look at the aggregate basis of their market cap, the overall industry is still worth about $650 billion, give or take, depending on the day. And $650 billion, when we look at Apple, is over 2.5, I would say closer to 3 times or so more, worth more than the overall industry. And it's not to be picky on Apple, but it's just the fact that one single company is worth 3 times more than the entire industry, that perhaps is the only industry that really benefits from all this macro environment that we're seeing today. So I think the asymmetry to this trade is interesting. I think the opportunity given the macro environment is interesting. I think fundamentally for value investors that have been out of favor, that will be interesting too. And for growth investors in general too. I think the new growth stocks will be probably the mining space in the next 5 years or so, and it's going to be where most investors will be looking for where is the bottom line growing, where are margins growing, and what are the most profitable businesses out there. With I don't know how long the Federal Reserve will be able to keep manipulating interest rates lower and corporate bonds yields at those record low levels. And therefore, in the next 10 years, if I don't believe that that's going to be the case, that we're going to see the same levels of cheap capital, cost of capital, I think the profitability will become much more relevant than it has been. And therefore, I think there's a high chance that mining companies will actually, be the ones that will lead this pack of profitability in general. So I think there's a lot of opportunities there.
Yeah, I just saw a headline before we connected on Zero Hedge, and it said that Stan Druckenmiller said he sees inflation coming back, and he sees even maybe 10% inflation as per the CPI, right? And you cover a lot about the real yields and the value of the equity market. Could you go over that a little bit? What you think could happen to the general stock market? I know today, as we speak here, the markets are gone back up a little bit.
Yeah, I think it's interesting how when you look at gold, for instance, and forces you to do all sorts of research regarding other alternatives of assets, because it's so hard to value gold itself, given there's not a stream of free cash flow or cash flows in general. What I like to do is usually look at gold relative to other asset classes such as corporate bonds and equities in general, and look at what are they generating in terms of earnings yield. Are they generating more earnings than, let's say, the inflation rate today? And that's not the case in a lot of companies. And when that happens, I think that forces, especially sovereign bonds with negative yielding bonds, over $15 trillion of those worldwide, forces a lot of investors to be looking for investing for price appreciation. And when you look at that relative, gold relative to M2 money supply and monetary base overall, I think that sounds and looks very attractive as an investment. It's incredible to me that corporate bond yields today are below inflation, and actually in real terms, it's at its lowest level in history. So when you think about conceptually, why would you ever, give money to someone that is, or a company in general that is highly indebted, or actually with that at extreme levels that we've never seen before, at record low levels? It's obviously manipulated by by central banks, and that have been participating in those markets in a bigger and bigger way. And I think that's, there's no way out of this. I think central banks will have to continue to do that. Otherwise, the whole system will collapse. And therefore, we like this idea of buying gold and selling stocks because there's no way around that. I don't know what the decision is going to be from the Federal Reserve front, but I would guess that they would keep printing money until they can. And so, I think, what Druckenmiller, a lot smarter than I am and with a lot more credibility than I have, I think he has a very interesting point about inflation. I think there is, unfortunately, if you look at money velocity, it still points to deflation in the following months, but we haven't had a lot of disruption on the supply side of commodities for a long time. And it's important to think about that because the geopolitical environment has been getting worse over the years with populism in general. I think that also will have, it serves as another, perhaps another probability of some sort of disruption in the supply market of oil and other commodities that are very necessary to cyclically move towards, economic growth. And therefore, I think that all could lead to higher commodity prices and hard assets that could lead to inflation. Monetary dilution certainly is a problem worldwide. In the U.S., it hasn't been one yet in a big way. Perhaps more on the side of asset prices have been inflated, but not so much consumer prices yet. But I think that could change in the following years. I think that there is a high probability of that happening, and if that happens, it would certainly change the environment quite a lot, especially with equity valuations that don't deserve to be where they are. Look at tech stocks trading at 50, 60 times sales today. I think those multiples make no sense if we have inflation, let's just say at 5%. I think there's no way those companies would be trading at those levels. So I think there's a potential, the downturn, the downside risk for interest rates actually rising is highly skilled, and I think there's a big chance that could happen in the next few years. It's not my base case scenario that it happens this year, but I think there is a pretty high probability. I think that's ultimately what's going to happen. Again, there's no way out of this besides inflating us out of this levels of debt, and the levels of debt go back to creating, organic economic growth. There's no way you can get organic economic growth at this absurd levels that we have of indebtedness worldwide. And so I think we're reaching a reckoning moment for equity markets at this, silly valuations that we see, especially in tech stocks. And, for me, it's just another reason to buy gold and sell stocks. And I think there's a lot of ways to play these two parts of this lag.
Yeah, and the thing as well is that since, let's say, 1987, which I think was a little bit like the crossing of the Rubicon in terms of central banking intervention, when Greenspan, flooded the market after the crash in October, it seems like all the crises are getting bigger, and the central banks are every time they have to intervene even more. And I think now with interest rates so low and even negative, in nominal terms and in real terms, investors are having to take a lot more risk. And the kind of environment we have, we saw back in March, where yields, actually, Treasury yields, first dropped really hard and then spiked higher. And I think the more the central banks keep intervening, they're going to create a very risky environment for investors, especially in paper assets. And I think eventually more and more, big hitters or big money investors are going to think, well, we need to protect ourselves with a kind of asset that hasn't done, as well. And that would be commodities, I think.
Yes, I think there's also another issue in the Treasury market in general, which I think is the most important market in the financial markets in general. Is why if Treasury markets, if we see a big sell off and not a lot of participants in this market, that should have also an impact on the dollar. But the issue here is regarding government funding. We see the government today hoarding somewhere close to $2 trillion in its cash balance. And, a lot of people ask themselves why that. I dig in a little bit more on that. What I found is that if you looked at the last 12 months, there's all this debt that we have issued recently because of coronavirus, and about 70% of that has been funded through bills. And so a lot of that will mature in the next 12 months. So now we have somewhere close to $5 trillion of bills outstanding in the Treasury market. So $5 trillion will be actually, at least $5 trillion will be maturing in the next 12 months. When you include all the other tenors, more of the notes and the bonds and so forth, what you have there is somewhere close to $8.5 trillion that will be maturing by the end of 2021. And so the government is not in a position where they can pay for that debt. So that's going to have to be rolled. So we're going to have somewhere close to $8.5 trillion, regardless if that's going to be long-term, short-term, medium-term, tenors. All those are going to have to be hitting the markets in terms of issuance. Who's going to pay for it? Who's going to be buying those? There's definitely some demand, or significant demand still for treasuries. And I think there's still going to be some demand. But more and more, the Federal Reserve is going to have to participate in this market and will be funding fiscal stimulus going forward. If you look at the number of people today claiming unemployment insurance benefits, it's close to 29 million or 200 or so million in the labor force. So I think that still shows that regardless if they get better, those numbers get better in the following months, if they stay above those 20 million or so, I think we still have a huge case for why fiscal stimulus will continue to be extreme for the following years, and which should have an impact on commodities in general, as we see more of a bad scenario of fiscal disorder that should lead to other assets to rise significantly.
Yeah, and I don't know if you saw recently, there was an article, I think, by a professor of economics in China, and he was saying that it was very possible that the Chinese could unload about 20% of their treasury holdings, which is like 200 billion. So that's another headwind. So where do you think the Fed balance sheet could go to eventually? Because as you spoke, these bills, to the viewers that don't know, Treasury bills are bills or debt that mature from 1 week or 3 weeks to a year. Everything above a year is a note. So yeah, they're going to have to issue even more debt to roll over the old debt. And what if interest rates start rising? They don't even have to rise that much, but from these low levels, these bills were probably financed at less than 1% or 0.5%. What if interest rates go up to 1%? That could be a big problem as well, right?
Absolutely, and I think that's the Fed's new mandate. And it has nothing to do with inflation. It has more to do with keeping interest rates low and keeping the equity markets at those insane valuations. Because if we're going to correct the equity market, it should be 50, 60% lower than where it is today. And so if they allow interest rates to move higher, then the equity markets those valuations is dead. And so I think, it's their new mandate. I mean, we calculated, if you look at all sorts of multiples in a fundamental spectrum of ways of looking at valuations, everything looks expensive, historically expensive. And a lot of those metrics are all at all-time highs today. So it's very difficult to justify valuations where they are today if rates move up. But it's going to be a challenging, decision for the Federal Reserve, in which we'll probably have to, fund a lot of the Treasury issuance that we're going to see in the next few years. And like you said, it's not something that's going to unfold in the next 5 years. No, it's the next year, and perhaps even sooner than that. We're talking about, regardless, $5 trillion. That will be maturing anytime from now to 12 months. And so that is a huge amount of Treasury issuance that we're going to see. And if the Federal Reserve is going to participate on that, that's going to be, on your first question, how big can the Federal Reserve's balance sheet get? I mean, it's going to have to be astronomically higher to cover this Treasury issuance. Maybe they won't take the whole 5 trillion, but let's just say they take 20% of that. What about 20% of the 8.5 trillion? That's a significant amount. We can certainly see, and that's considering deficits don't get any higher. Deficits just stay where they are, which I don't believe in that either. So, the debt is accumulating over time. It's getting bigger and bigger. It's having an issue with, if you look at the discretionary versus mandatory budget for the government, the mandatory is becoming, massive. It's starting to hurt even national defense spendings, as we've seen military spendings decreasing significantly as a percentage of the overall budget. As in absolute terms, it's still rising. But this is all going to have an impact on growth at some point, because we're going to see, fiscal stimulus that's going to have to be only not really stimulative. It's actually for mandatory reasons. And so it's going to be a very tough environment for the next few years for equity markets, in my view. And I think it's going to be a very interesting environment for hard assets and assets that serve as alternatives of the monetary system, regardless if that is gold, silver, or Bitcoin. I think all those have space to grow, room for growth, and potentially even much higher than where they are today.
Yeah, and we're not even looking at the political aspect as well. If we have, Democrats do well in the next election, and they're probably going to spend even more. All this debt as well that the government is taking, and you talk about automatic, spending, and people politically, they're going to be clamoring for even more fiscal stimulus, and all that does is crowd out the private sector and hurts the private economy. It's like a vicious circle or a vicious cycle of indebtedness that is going to weigh even more on the private economy. And I think deficits are not going to go down anytime soon. And even before this crisis, in the last year and a half or so, the Treasury was running like 5% of GDP budget deficits.
Yeah, it's interesting when you look at the deficit relative to GDP. It's somewhere close to 15+% today, which is World War II levels. But since the 1970s, when we've had the break of the gold standard, and that was really the beginning of this fiscal monetary disorder. It's interesting how the deficits have only gone higher. It's one of the few clear upward trends that we have in charts in general, is certainly that. And that has boosted a lot of economic growth in the last few years, in my view. Now, at some point that's going to have to reverse. And I think there's a few ways that could happen. And one way would be taxing people and corporations much higher than where they're being taxed today, and that's going to hurt consumption. That's where I think why I believe that it's going to be, you can run away from the reckoning moment in which too much debt leads to, monetary destruction and downturn economically speaking in terms of growth. But we've been fighting away with monetary dilution recently and fiscal stimulus for over a decade, since the global financial crisis. And so I don't know. I don't think that it's a lot of investors are thinking that we're probably going to have another decade or so of very prosperous growth in terms of equity valuations. And I don't think that that's going to be the case, especially because this is not an 2009 scenario. In 2009, valuations were extremely low. And it was not just because earnings were depressed. It's because prices are depressed too. Today we have earnings being depressed, but prices at all-time highs. I think it's the first time in my career, and I can tell you this is the first time in history, because I've never seen anything like this. And I know everyone talks about, but equity markets are discounting a future cash flow mechanism type of market, and that makes sense. Sure, it makes sense, but that never happened throughout history. And so I think it's, we're at a euphoria type of market in which companies splitting their shares causes markets to surge. There are bankrupt companies doing really well. It's a market that I've never seen before. It certainly seems like IPOs of companies that make no money. We see record amounts of IPOs happening in Brazil now. And what's going on? It's definitely not a normal environment, and it is product of all this monetary stimulus that we're seeing. The funds fiscal stimulus and funds companies to be able to survive at periods when they make no money. So we've seen Tesla performing better than Venezuelan hyperinflated stocks. There's so many examples of issues that we're seeing that. I think that it's all reflecting this environment, this extreme environment that we're looking at the same time as you have, silver relative to money supply at near record lows.
That's what I wanted to ask you about. Is silver, I guess, your favorite precious metals, right? In terms of how much of a bargain it is, right?
Well, I like silver, especially. Well, as a portfolio manager, I like silver in general because it's cheap. But as a still young person, I think, if I want to look for real potential upside returns with high risk, FYI, I think silver is the best. It's even more attractive than things like Bitcoin. A lot of people think that Bitcoin has, also a lot of upside given the size of the market. It's true, but I much rather buy silver that has a tremendous amount of history, has been part of the monetary system. During developments of in the Western world, centuries and centuries ago, when we really started globalization, silver coins are the whole reason why countries were able to buy and sell goods and services and buy things from the West, especially from areas like South America. And so silver has been part of the monetary system for a real long time. And the whole idea is that a lot of, the counter argument is that silver is a very interesting commodity, but it's a very industrial and cyclical commodity. That's true given the price of silver being so low, and therefore allows, electronic companies to build products using silver because of the level of silver prices. If silver prices go higher, it's going to more and more become this monetary asset rather than an industrial asset. I think that that's going to happen. And it's, you can tell that if you're more involved in this mining space, you can tell that by looking at companies, the amount of companies that have changed their names that used to be silver related to more precious metals related, even though they continue to be, have a significant amount of silver production. In other words, they're worried about having silver in their names because of how, how poorly silver has done throughout the years. And that tells you that even those guys don't believe in it. And it's funny because there's a lot of, silver is a byproduct production type of commodity in which it's very hard to find a pure silver producer. Usually you find a copper or gold producer that has some silver as a byproduct and then ends up selling it. A lot of those, especially copper mines, have shut down in the last few years given the performance of copper. The amount of discoveries of silver has been even probably lower than gold. And so it's, the mismatch from the supply and demand side, it sounds very, very appealing to me. And if I can look for one very cheap commodity, I think silver is the cheapest metal in the world today. So, I want to own silver deposits, places where I think there's a lot of silver in terms of exploration. I want to own silver. I want to own anything related to this metal. You can look at silver versus money supply index, and it's very clear to me that it's not it's just been forming this beautiful base for the last few years that I think it's ready to break out and go a lot higher than its 2011 levels, and I think it's going to go even higher than 1980s or so when it reaches its record levels. I think the late 70s and 80s. And I think I think there's a big chance that might happen this time, given the level of imbalances that we have, number one, the lack of alternatives of investments in general. When you look at silver relative to equities, just do Russell 3000 total return versus silver, and you can see it also, the opportunities right there screaming in your face. Silver relative to Russell 3000 is doing a perfect double bottom as of recently, and I think it's poised to go much higher. We've seen recent as well, silver being outperforming even Nasdaq, not today, but certainly in the last few days. With even with Nasdaq falling apart, silver actually held up incredibly well, especially yesterday.
Oh yeah.
With Nasdaq down 4.5% and silver was up. And so I think that is where the growth story is. And wait until the silver miners begin to really take off. I mean, we've had a lot of exploration ideas in silver names that are up 300, 400%. I think the party has only started. I think a lot of those firms have a lot more to grow.
Could you maybe just tell our viewers a few of the issues, silver miners that you like?
Sure. I usually like to, we have been disclosing names that we've been doing activist deals in this mining space in the last few years. And there's a lot of interesting plays in terms, again, silver is a byproduct, so it's very hard to find pure silver explorers. And we are focused on exploration part of the segment of the industry, given our views about where we are in the cycle for gold. I think we're at the very early stages of a bull market, and it could look like a frenetic bull market for gold for the next 10 years or so. And if that's the case, I want to own the most volatile and most upside probability that I can find, which I think is the exploration part of it. And a lot of investors are running away from that, saying that's kind of gambling, and I don't want to mess with that. The world is really hard to find new discoveries, and that's exactly what I want. I think there's a lot of dysfunctional parts of the market in that segment of the industry, given the lack of participants in that. So we partner with a geologist, Quinton Henney, to look for the best deposits in the world today. A few of them would be SK Mining, is probably my favorite company, is in the Golden Triangle. I mean, the Golden Triangle area has had it has a significant amount of silver, by the way, but it's certainly a lot of gold too. And there's a lot of those names since we started this run in gold have done tremendously well. And I think SK Mining has probably one of the best properties in that whole space. It'll be proven if those drill results come out as positive as I think they will be. And I couldn't be more bullish on that company, SK Mining, safe jurisdiction with. SK Creek was one of the largest mining projects that we've had in history with Homestake Mining. They used to own that. It was the whole reason why Barrick bought them out back, decades ago. It was a moneymaker for Homestake Mining and became a moneymaker for Barrick. That's one of the companies. The second one will be Eloro, ELORO. Eloro, it's also in Eloro Resources is in Bolivia. It's also another silver, probably a world-class silver deposit will look like in a few years. We have another one, Condor, in Peru. That's another interesting one. Defiance Silver is another interesting name in Mexico. So there's a lot of interesting plays that have silver and significant amount of gold. White Rock Minerals is a very interesting play as well. It's a 30 million company with about 15 million in cash, 2 properties. If they spin off one of those properties, I highly doubt it would spin off for less than 15 million on one of them. So it's trading way below its book value.
Are they all listed in Toronto and also in the US, most of these, or?
Australian markets too. Yeah.
Australian, yeah. The one you said, is that El Loro, the one in Bolivia, or Loro?
El Loro with the E.
Is it El Loro Resources, is it? Is the CEO a guy called Larson, I think?
Yes.
Yeah, I actually know him. Yeah, I know that guy. I did an interview with him a few years ago because he knows my brother-in-law in Switzerland. Yeah.
Oh, no way. Good. He's a smart guy.
So he's involved in silver too, is he? I thought it was just gold.
Well, those deposits have a lot of silver,
I'd say.
significant amount of silver and gold too, and even copper. And like I said before, it's hard to find a pure silver mine, but it's definitely a significant amount of silver in that region. And Peru is the same way. Perhaps the New Mexico. Mexico is very famous for a lot of silver producers, but Peru certainly has a lot of upside potential for finding silver. And believe it. What's interesting about believing it, and Tom can sure tell you even better, way better than I do, in terms of the potential for finding a lot of deposits there. I mean, the world has been beat up in a big way in terms of exploration, but there's a lot of potential in areas like Bolivia that a lot of people have avoided for political reasons. But I think we've had other mines in that region that did incredibly well, and I think this could be another one. I think those guys are well connected, and when you find that in a very interesting deposit with very interesting geologic propositions for why you should own that, I think it all makes sense. I think we're a lot of those good deposits will be bid up by a lot of the larger producers anytime soon because of the lack of discoveries. And those guys, if they want to keep those productions numbers that they have put out in the last few years, they're going to have to buy up or explore more on their own. And I think since we've had a lack of exploration worldwide, especially from the larger producers, there's going to be a lot of consolidation in this market, in which I think a lot of those small exploration ideas will be in good positions in the following years if this all plays out.
Great. And I guess, like you said, it's going to be like Pac-Man, the bigger guys eating the smaller companies, because it's much easier to do that than go explore yourself. And what about like more mature companies like Hecla? Do you hold that also as part of your portfolio, or are you just focusing on the exploration part, like
Well,
the junior miners?
I think the whole industry looks appealing, so I think the whole industry is going to go a lot higher. The big guys, Newmont, Barrick, Kirkland, all those are probably going to continue to go higher. B2 Gold, they're all going to be, with gold at least at $2,000 an ounce. They're tremendously profitable at those levels, and gold doesn't need to move anywhere, which I think it will. But just saying,
Yeah.
silver, gold and silver stays at those levels. Those guys are much more profitable than almost any tech company in the world today, and so I think that all those names will move higher. Again, the reason why we're in exploration side is just because of the how early we believe we are in this market, in this bull market we believe to be a bull market, and we want to be in the very small names, because I think that the potential for upside here is probably going to be much higher in those versus the more developed stories. Doesn't mean that we don't like them. We have a large cap strategy, and we manage other strategies that we look at the bigger names, and we own a lot of them. I can name a few, but all those companies you mentioned, Hecla. That's one of them that we actually don't own. Hecla does have a lot of leverage. It's one of the firms that is more indebted, but also has leverage to the upside too. So I'm not saying I don't. We don't own that name specifically, but there are other names that we're also involved in more large cap parts of the industry. In our global macro and precious metals fund, it's only exploration mostly.
Yeah, and I guess you get you're going to get a lot more leverage on the upside with the smaller companies. So before we finish, could you tell the viewers where they can find your work, and also maybe how someone who'd be interested in putting money with your fund, what they have to do, and what the minimum amounts are, and things like that?
Yeah, the minimum amounts of investments will range on the products that we provide. There's 5 strategies, 2 separate managed accounts, and 3 hedge funds. The hedge funds will vary from 250K minimum investment to 100K. And the other separate managed accounts, we have a precious metals one that is a mix of larger companies and smaller companies, and that's only $25,000 minimum investment. Since it's a separate managed account, it's actually only a 2% management fee annually, versus there's no incentive allocation on that one. Large cap is another one that we have since 1999. Track record. It has, beaten the S&P average returns in a huge way. I think that's has been through at least 3 market cycles. It's a very interesting product. We have very long-term strategies and some that were launched recently, given our views about precious metals. We can, we have a very open website for anybody looking for that, Crescat.net, www.crescat.net. You can contact us from there. It's pretty easy. And also, most of my work is in a website in terms of the letters that we put out, interviews, anything like that. But also Twitter, Instagram, and LinkedIn are 3 platforms I've been using to really share some of my views and company views on charts and ideas that I think are important to point out. My Twitter handle, I think, is @Tavi Costa. You can find me on LinkedIn as Tavi Costa, or if you want to find me on Instagram, it's @Tavi Costa Macro. And so, yeah, happy to discuss and share more of my views. But those are the places where you can find my previous works.
Great. And is it open to investors from all around the world, or are there like rules about you just have to be U.S. investors, or?
No, it's open around the world. I think we have an offshore fund as well, especially for the hedge funds, for anybody interested in that. And the separate managed accounts, actually, surprisingly, especially through Instagram, which I was not expecting that, given maybe just I didn't think it was going to be a lot of more sophisticated audience there, but I was wrong. And that's why, it doesn't cost you anything to share your views in any platform. And I decided to open an Instagram account and started opening a lot of Brazilian accounts. Very interesting and very good, because there's not a lot of ways for Brazilians to bet on or invest on mining companies. And I think we offer products or strategies that can serve that purpose for a lot of people. And we've had a lot of Brazilian investors now, especially in a separate managed account. The minimum is $25,000, and it's great. I'm happy for that. I'm happy I'm being able to help a lot of those investors, and I hope we continue to grow in that region as well.
Yeah, because in Brazil, historically, Brazilians have used the U.S. dollar to hedge, the currency debasement, and probably precious metals is not something they've looked at that much.
It's a very good point what you said, and I think the miners serve a very interesting purpose, because it gives you through 2 legs of investments in one investment. In other words, you get the metal prices going higher, improves your margins, but what also improves your margins is the depreciation of those currencies. I think we're in a race to the bottom of all fiat currencies, but I think emerging market currencies are in even fundamentally weaker than places like the US dollar or so. And so if those currencies depreciate even further relative to the dollar, their costs that are actually in Brazilian real or any other currency worldwide, should also become cheaper. So if their costs is reduced by that, at the same time as metal prices go higher, is another way to be long gold versus the most overvalued currencies in the world. I think the miners, give you that option in a very interesting way.
Tavi, thank you very much. I really enjoyed speaking with you. And thank you for giving us your time.
Thank you very much. Thanks for having me as well. And I appreciate the opportunity. Look forward to talking to you again.
Yeah, me too. Thank you.